Good morning, Team Smarter, and welcome to another week with Pete. Today's topic is when to buy and when to sell. Now, if you've been following us for a little while, you'll know that we believe that the bottom end of the market at the moment is within the Brisbane marketplace. Recently, BIS Oxford Economics, which is Australia's leading macroeconomic forecaster, has recently predicted that within the next couple of years, so from now till 2021, there's going to be double-digit growth, anywhere between sort of 10 to 14%, depending on where you buy within Brisbane itself. But the reality is that it's good news for people that have recently bought in Brisbane, because you will be finally achieving double-digit growth. It's a bit like our business partner, Ruben Macken, obviously a genius in my eyes, but the reality is that he's recently sold a unit in Sydney because it's the peak of the market, and he's bought a property in Brisbane, being an income producing asset within the Brisbane marketplace. So Ruben, you're a genius. I think so anyway. Other people may argue that point, but I think you're a genius, mate, so well done. When you take into account the overall marketplace, the marketplace is counter-cyclical, and we've said that many times in the past. Sydney becomes too expensive, people move out to Melbourne, and then they sort of head out to the Brisbane marketplace. So the population is obviously there to be able to not only justify capital growth, but that systemic growth rate within the next couple of years. Now, that's when you buy, but when do you sell? When it comes to selling, it's not a matter of just cashing up and buying within the same marketplace, because if you're trying to justify the same state, it makes it really difficult to be able to predict. If you're buying in different states, you can see the counter-cyclical motion within the actual marketplace. The other thing is that you've got to take into account what is called the Rule of 72. Now, the Rule of 72 is a formula that enables you to indicate how long it's going to take to double your initial investment based on a fixed rate of return. Now, there are 2 points there: initial investment and fixed rate of return. If I'm a bank manager and I've just recently received $100,000, let's say for the sake of my mathematics, an inheritance, and I put it into the bank. Now, if I did that back in the late 80s, when the banks were handing out 10% interest on a term deposits, then, mate, happy days. If I put it into the bank using the Rule of 72, divide that by 10%, which is the initial rate of return, is 7.2. So that means that my initial investment of $100,000 is going to double in value in 7.2 years. Fantastic. So the bank of old school back in the late 80s actually worked. But you can't do that now, because a term deposit is only around 1.5% to 2% per annum. So again, applying the Rule of 72 is that 72 divide that by 2 means that it's going to take me 36 years to double my initial investment. So how old are you going to be in 36 years? It's the old walking frame. That's right, my back's hurting just even thinking about it. You're going to be too old to friggin' enjoy it. So the bank of old school doesn't work, which is why you need to be able to purchase at yield. Now, here's why. If I'm purchasing an investment property that has, let's say, a 5% yield, that is my initial rate of return. So applying the same formula, 72 divide that by 5 is 14.4 years. That's going to take me to double my initial investment. So my $100,000 will now double in value in 14.4 years, because it's the compounding factor that we've got to take into account, which is why we're always looking at assets that have a very high yield. Now, that's what it's all about. So when it's time to sell, you sell when you double your initial investment. Now, I hope that makes sense. Now, if it's unclear, by all means, send us an email, send us a text, reply to this video. We'd love to be able to sort of help you out. What I'm trying to basically state here, and I know it seems a little bit confusing, there's a lot of numbers, especially on a Monday morning. I can't even believe I think I've got those figures right. I haven't even had a coffee yet. But what the point that we're trying to get here when it comes to sort of smarter tenant and what we take into consideration is that the time to sell is when you double your initial investment. So if I'm buying a property, let's say at 500,000, I didn't buy it for 500,000. I didn't invest $500,000. I only invested my deposit of $100,000, hypothetically speaking. So when I double that $100,000, that's when it's time to sell, when you double your initial investment. Now, if you're buying and selling a few times and you've been able to develop a really, really good, strong portfolio, like a long-term systemic growth within your portfolio, then the other answer to when to sell is not to sell. Because if I'm generating strong cash flow, we're here for the long term. Why would we want to sell it? The only people that you should be considering selling your portfolio is your grandkids. Have a great day. I hope you've enjoyed today's Week with Pete. If you like what you hear, make sure you like it, share it with your mates, share it with your friends. Love to be able to help you out. Have a great day. Thanking you.